Hello and warm welcome to all our viewers joining us today. In this video, we will discuss the position of EB-5 funds in the project capital stack. We are going to do this together with Nick Bernagorio, the Senior Vice President of one of the largest regional centers in the US. Nick, thanks for joining.
Thank you so much for having us, Barbara.
Before we talk about the project financial stack, can you please share with us how a typical EB-5 project is structured within your regional center?
Sure. So in any development project, whether there's EB-5 or not, there will most commonly be some combination of equity, which is cash or other assets from the developer or other investors in exchange for an ownership interest in the asset. So that's one type of investment. And the other type of investment is debt, which is essentially loans from banks and other financial institutions lending money to the project. And they're getting an interest rate, and at the end of a specified term, that loan is repaid back to the bank or financial institution. There can also be other types of financing that can be used in a project budget, such as grants and different types of bonds, for example. But for simplicity's sake, let's focus on traditional equity and loans for now. So equity investors typically have the possibility for higher rates of return if the asset increases in value, but they also bear significantly more risk. Loans, on the other hand, will have lower rates of return, but have substantial safety enhancements. EB-5 investments can be structured either as equity investments in projects or as loans to projects. And at Can-Am, we only use the loan model. In fact, Can-Am was the very first regional center to have the loan model tested and approved by USCIS. And a project can have a single loan from one lender, or a project can have multiple loans from different lenders. And there'll be a hierarchy for those loans. The highest priority loan is typically called the senior loan in a project. This is the largest loan. It has the highest priority in terms of repayment and in terms of collateral protection. And these are commonly loans from large commercial banks like Bank of America or Wells Fargo, regional banks that may provide loans to projects in their local vicinities, or institutional asset managers that provide commercial loans as part of their investment portfolio. These are all common senior loans. EB-5 is most commonly structured as a junior loan, or what is called a mezzanine loan. A junior loan or a mezzanine loan sits ahead of equity investors in a project budget, and it sits below the senior lender in a project. So mezzanine or junior loans are the most common structure that we see in the EB-5 industry and that we commonly use here at Can-Am. But there also have been some cases where we've been the senior lender in a project. We could be a mezzanine, and in some cases can be a senior. And there will be many factors that go into this structuring, but at a high level, when your clients are evaluating projects, they really want to have a clear understanding of where the investment sits in terms of priority of repayment and if there is sufficient collateral protection to cover them.
If we talk about investors who are looking into the EB-5 project, they actually want to know where they transfer their funds first and what kind of documents actually coordinating or describing this relationship. So if we talk about the loan model, does it mean that investor itself is signing documents where he loan money to the project?
So the way we structure things at Can-Am is for every single project that we structure, we will form a new limited partnership. It's a partnership model. We at Can-Am act as the general partner managing the investment, and the EB-5 investor families are the limited partners. So they're buying a unit of the partnership. They're buying an equity interest in the partnership. So at the partnership level or the NCE, new commercial enterprise level, it is an equity investment. And then the partnership is very simply acting like a bank. The partnership is going to provide a simple interest term loan to a developer. Those terms are typically 4 or 5 years, subject to extension options. So at the project level or the JCE level, the job creating enterprise level, the exposure is as debt, as a loan. And at the partnership level, the investor's exposure is as equity.
Would it be right to state that in majority EB-5 projects, that's at least what we have seen, the structure is as you described, the first investors getting into the NCE and in this transaction, they are like equity participant in the new commercial entity. And this new commercial entity actually pass funds to the project, which creates job. And the second transaction can be actually arranged in the different forms, as you mentioned before, loan, equity, and I guess preferred equity as well.
Yep, those are all possibilities, absolutely. Again, at Can-Am, we only use the loan model, but different groups structure things in different ways, and they'll have different risk profiles and terms. But that's absolutely correct.
So if we look at the way how this new commercial entity passing funds to the job creation entity, as you said, it's a loan, preferred equity, or equity. And if we take these three and briefly describe the level of risk which investor would face in these three options.
Sure. So, I mean, the people that have the most risk and the most upside are typically the equity investors. Then the preferred equity investors sit on top of them. Then people in a loan position have the most seniority in terms of repayment. They're the first people to get their money back, but they also have the lowest rates of return. So people in a loan position will have a lower rate of return, but they have the most security.
But here it's actually maybe a bit confusing for investors because we have these three different type of investment to the JC, the project job creating entity. And there are different rates, interest rates, which are paid for using the funds, and they depends on the structure which is used in this project. But at the same time, investor is getting the different percentage of interest. And in some projects, actually funds can be used as equity investment in the JCE, but the return which investors would get still be very, very low. And let's say would be 1% per year.
That's exactly correct, Barbara. So yes, when you're speaking with regional centers, you do want to have a very clear understanding of how your investment is structured, both at the regional center level, the NCE level, and at the JCE level.
And if we talk about the loan option, there are also different types. As you said, the senior loan can be in place, collateral can be in place. What else investors should check about their loan to the project?
Yeah, so they'll want to first have a very clear understanding of what is the loan term. Are there extension options? Often some groups may advertise just the initial loan term, but often these projects do have extension options, which are most commonly at the discretion of the borrower. I think it's just prudent to assume that any project that has an extension option, for an investor, like anything else in life, you want to be prepared for the worst case scenario. So if a project does have extension options, I would assume there is at least a likely scenario that they would use the extension options. Extension options are really designed to give borrowers flexibility in terms of refinancing. And refinancing is based on various data points that no regional center can reliably predict into the future, which include but are not limited to what are interest rates at the end of the initial loan term? What are the market's expectations of interest rates going into the following year? What is that particular borrower's liquidity needs, and countless other data points that no regional center can really predict into the future. So if a project has a loan extension option, I typically tell my clients, I can't tell you whether or not they'll use them now. To manage your own expectations, assume they will. And if they don't end up using their extension option and they repay after the initial term, you get your funds back early. Happy days for everyone.
And let's say at the end of investment term and extension period, the project cannot find refinancing. So, and he cannot return this amount from their operational cash flow. What would happen?
So that's when, at least in a loan model, a regional center or a lender of any type would exercise their rights on collateral, and they would use their collateral protection to cure a default.
Okay, great. Thank you so much for your time and interesting conversation.
My pleasure, Barbara. Thank you for having us.
And I hope it was interesting for our listeners as well. If you have more questions, please ask them in the comments below, and we will be happy to answer them. This video was hosted by Second Wind EB-5, a third-party promoter working outside the US. Our goal is to provide the best choice of the EB-5 projects from regional centers with proven track records. Hope you liked this video, and if you did, please hit the like button and subscribe. Bye.